Here we're live streaming this morning, discussing with the Rabo, or members of the RaboResearch team, some of the key things that are happening in our industries at the moment. We've discussed a number of ways of looking at industries, and there are always a number of lenses we can look at an industry through. We can look at global marketplaces, we can look at supply chains. In the dairy industry, the increasing listing of companies on stock exchanges in Australia and New Zealand or offshore in the last decade or so have provided us with another lens through which to look at an industry. And that is the public statements that listed companies make about their earnings throughout the year. Are they doing better or worse, and why is that the case? We've just passed through what the financial press likes to call the earnings season. And a lot of companies have reported. We've seen A2 deliver scintillating results. Other companies showing slowdowns in sales to the Chinese market. So we'd like to bring in now senior dairy analyst Mick Harvey to discuss what we can learn from the most recent earnings season when it comes to dairy. Mick, welcome to live stream.
Jim, it's great to be here. Thanks for having me.
Very pleased you can fly in. You've been around the country. Earlier this week you were out with clients in
Mount Gambier, Northern Victoria next week, and Sydney at the moment. So it's that time of the year for the industry, Tim. Lots of conferences, lots of field days, and lots of branch events for us.
And that's often something our clients can lose sight of, Mick, is that we are a research team. We need to stay at our desk to learn certain things, but we spend an enormous amount of time out and about with our clients, speaking about the insights that you can deliver, but also learning from what is going on the ground at farms and with the processing sector.
Absolutely, and I've already caught up with a couple of our dairy clients from Northern Victoria up here, and clearly that's a bit of a flashpoint for our industry, and water's a big issue, so we've already had a good catch up with some of them.
Yep. So Mick, let's move to the topic for discussion today, and the earnings season that we've just been through. Perhaps we can start with our audience. Who are some of the companies in the dairy space or around it that are publicly listed on stock exchanges these days?
There's sort of two groups, Tim. There's the locally listed dairy companies, and that can include the traditional dairy processing companies like a Bega Cheese or a Freedom Foods, who are fairly new to the market. But then you can also look at the results of some of the multinational dairy companies that have big businesses here in Australia. So that can include, the Parmalats who report regional performance, Saputo, who now own the MG assets, report their international division, and then you get Fonterra, who obviously report and strip out the Australian ingredients business as well. So you've got those two groups, and then you've got obviously a lot of infant formula brands that have listed, and we always pay close attention to how they're performing, because it's such a big product mix that we're doing these days, and it's a real value add product that we're offering our industry.
And Mick, almost across all commodities that we look at through Australia and New Zealand, China is our key market, or one of the key markets, and nowhere is that more true than in the dairy sector. Most of our audience will be aware that there's been a lot of coverage recently about the slowdown in the Chinese economy, and the potential that it's slowing a lot more than is reported. What did the earnings statements of listed dairy companies tell us about what's happening in China at the moment?
There was mixed, Tim. I mean, and you mentioned earlier, A2, and A2 are a company that have performed really well in China for a long period of time and continue to grow volume, grow margins. So their China business is strong, and they continue to perform well. But there were certainly some indications from other dairy companies and dairy-related companies where they clearly talked about some of the slowdown that they're seeing in their business. And it comes back to a couple of things. It's that broader slowdown of their Chinese economy, and that is starting to impact the performance of certain categories. You then overlay that, and this is an important point for a market like infant formula, where something our colleagues talked about who's based in China has talked about the number of newborns in China is slowing. So the overall structure of the category is slowing there. But equally important to what's going on in China, a lot of these dairy companies talk about increased competition, one from other exporters around the world that are trying to capture their piece of the pie in China, but also just strong competition from local players who are have got a strategy and a long-term vision to improve their own business and become stronger, better players in the market. So there's a whole range of headwinds, and that is clearly evident in some of the reporting that we've seen so far.
Yep. And that's something we're watching closely at the moment, both inside and outside ag, because when we deal with an opaque market like China, where the credibility of the official statistics is actually questioned, we're watching closely to see what publicly listed companies say, and companies as diverse as Apple, 3M, the industrial company, Caterpillar, and the Ford motor car have all announced earlier this year significant slowdowns in their sales into that market. But more of a mixed experience for dairy.
Yeah, and the other one that I didn't mention there is, and this is purely related to the infant formula category. There's clearly regulatory risks that are still there in play, and companies like Bellamy's don't yet have SAMAR registration, which means they can't sell Chinese label product into that market. Now they're expecting that to come through, that registration to come through in the next 6 to 12 months, but at the moment, they've lost access to one of the key channels to the market, which is part of their week of the performance that they announced recently.
Yep. And interestingly, when companies like A2 and Blackmore's outside dairy, but selling into the Chinese market, reported, they did discuss sort of shifts in that daigou space as well, Mick. What's going on there?
Look, it's an important channel to market. Clearly, there are a lot of Chinese consumers and tourists and visitors that come to our shores, and they do buy on behalf of customers back in China. So we've got a lot of dairy companies and infant formula companies that rely on that market and that channel to market for success. So, look, there's a lot of regulatory risks that we've been seeing in the infant formula category over the last couple of years. Yep. The most prominent issue at the moment is really around SAMAR registration for Chinese labels. But, the daigou channel is important. It's still open to trade. Yep. But there's certainly been some challenges there as well. Yeah.
Yep. So would you characterise through the lens of what we see of the earnings statements and what we know elsewhere, the Chinese market for dairy is still growing, but certainly slowed down?
Yeah. Look, the long-term fundamentals are still sound, and we truly believe that. When it comes to infant formula, it is the world's largest infant formula market. Yep. It's still growing at a rate that's traditionally above a lot of other dairy categories in more mature markets, and it's a value-add play. So if you get it right, there's value to be captured for the supply chain locally, absolutely. But we recognise that, it is slowing down a little bit. There's regulatory risks, and there's a lot of competition in that market at the moment.
Yep. Okay. Mick, another thing that we saw a fair bit of in the earnings statements is comments around the impacts of competition for milk and what that does to milk pricing and margin. Tell us a little bit about what came out.
Yeah, look, and the context there is, Australia's dairy industry is going through a tough time. Milk production's falling quickly. I don't think we're past the worst of it yet. So the current modelling that we do suggests that by the time this season finishes at the end of June, we'll be at 22-year lows in terms of national milk pool. Yep. And that's after a 7 or 8% drop in production in the current season. So that's a lot of milk being stripped out of the system. And there's clear risks, and we can talk about that, Tim, but clear risks that potentially we see another fall next year. Now we're suggesting flat production growth at this stage, but a lot of risk around where feed prices go and where water goes. But that's the context. So you've got a big drop in milk production, very concentrated where that drop is coming from. The biggest part of that fall in production has come from the northern Victoria, southern New South Wales region. I think that they're responsible for about 75% of the drop in milk production to date. Yep. But you've also got big falls in production in percentage terms in the northern drinking milk states. So what they're doing is dipping into that milk pool in northern Victoria, southern New South Wales, in an environment where they've lost a little milk supply. So the flashpoint there is lots of competition in that region. Yep. In a sector where there's a lot of capital invested in stainless steel and more coming on stream.
Yep. So an environment in which the market forces for the raw milk, in terms of probably decent farm gate prices, but high feed costs, high water costs, are leading to margin squeeze. But downstream also a margin squeeze, because competition for milk means that they're paying very full prices for that product to some extent to help out the producers, but to some extent straight economic grounds, get the milk, maintain capacity utilisation and downstream sales. So margin pressure to some extent through the supply chain. How do you see that playing out over the next 12 months, Mick?
Yeah, and this goes back to late last year, Tim, where we saw Bega Cheese obviously, lift their milk price, and specifically state in their commentary that was in response to strong competition in the region. At that time, we hadn't seen the commodity market improve to deliver that milk price. So they've said we're matching our competitors. That's coming at a cost to our business, and they reduced their profitability expectations for the current season. And then subsequently, since then, we've seen results from Fonterra with their Australian ingredients business being under pressure as well. So that margin squeeze is real. It is across the supply chain. No doubt dairy farmers have been doing it tougher for a longer period of time, but processors are having their margins squeezed as well. And that's part of the story around what we look at in terms of that supply chain and that value chain. Most dairy companies that reported in the last couple of weeks have all suggested that their profit margins are down on where they were at this time last year. Right. It doesn't look great in terms of a rapid recovery in terms of profitability, because we know that the milk pool environment's still pretty tight. Not likely to improve anytime soon. So that competition for milk will be an ongoing feature for the industry, and that comes in a number of forms, but it's really, when you break it down, it's about recruitment premiums and retention premiums, and that's what we're seeing play out in certain regions, particularly Northern Vic, Southern New South Wales.
And Mick, the companies reporting their earnings, we've seen and talked about just now, margin pressure through the supply chain, but we also see a range of more structural changes in the supply chain too. How is that panning out, and do we have further to go in that space?
We certainly do. I mean, this is something that we've been talking about actively, Tim, for a couple of years now, and the most recent transaction and impact on the supply chain was the sale of Murray Goulburn. I mean, you take out the biggest cooperative in the industry, that's a structural change to the ownership of the supply chain. But clearly, we're still seeing the washout of that, and some of that's assets being closed, and Bega Cheese closed the Coburg factory in their most recent round of announcements. Now that they've bought the Croydon facility and they have a milk pool down there, they didn't need the Coburg factory. There's a close watch on the Lion Dairy and Drinks business, which is still going through a trade sale at this stage. But we saw in the reporting announcements that over the last couple of weeks that two of the reported front runners for that asset, being Freedom Foods and Coca-Cola Amatil, have pulled out of the race. So that does take away one of the key partners that everyone was thinking might be buying that beverage business. So that's clearly a sale of a dairy company that's it's not the size of Saputo or even Bega Cheese and Fonterra Australia, but it's certainly one of those larger processors in our industry, has lots of strong brands. So we're all watching to see where that ownership structure lands. And I think the most recent commentary from its parent owner, Kirin, and the local board has been that they will potentially keep the asset if they can't find a suitable buyer.
So a lot of movement at the moment. We have the margin movement we talked about. Changes in ownership through the supply chain. Also seeing a fair bit of movement, Mick, in alternative supply chain products, if I can call them that. A2 posting exceptionally strong results still, and a story that has surprised many in terms of its longevity and penetration. Organics still also appear to be rising. How much further to go do we have of these alternative supply chain products expanding into the marketplace, both here and offshore?
Yeah, look, we are still seeing companies invest, and it's probably part of the broader theme around investing in value add, Tim. And Bega Cheese made a recent announcement where they're expanding their capability to produce more lactoferrin. Now, the end ingredient for that often goes into infant formula, but can go into other categories. So, the strategy there for Bega Cheese was, it's not just about investing in capacity to handle more volume, particularly in an environment like this. It's about investing in your capability to extract more value from every litre of milk that you do get. So it's value extraction is different for every different company, but certainly a big part of that is finding those niche branding opportunities around repositioning your milk pool, and it's A2 and it's organic and it's grass-fed. There was an announcement last week, I think, where there's an infant formula company that's going into an organic A2 category, which is super premium. So it's all part of that value add play that our industry's going through, and it is probably the right strategy, because we need to get more value from every drop of milk that we do have. There's still that big question for the industry around how much stainless steel we have, where it sits, and what does that mean for the supply chain long term.
And there is investment still flowing into the sector, isn't there, Mick?
It is.
And is it that strive for value add and more efficient supply chains that underpins that?
Yeah, absolutely. I mean, there is companies still building new stainless steel, and I get asked this question often is around why are they all investing in stainless steel, and you need to be careful about looking at it as a bundle of investment. When you look at certain projects and investment strategies in isolation, they make sense. There's a company that's picked up some UHC contracts, so they need to expand their capacity quickly. There's a Fonterra rebuilt Stanhope in northern Victoria after a fire. There's an organic factory or two being built. So they're in isolation. They make strategic sense. It's the challenge for the industry collectively is though we're likely to head into the new season with record volumes of excess stainless steel. A lot of that sits in northern Victoria, so that's the challenge. Now certain companies can mitigate that risk around being able to tap into other milk pools and make sure assets are being utilised as best as they possibly can. But we are, as an industry, carrying a lot of excess stainless steel, and that's the challenge.
We've mentioned that there's been growth in alternative supply chain products, and of course, if the consumer wants it, there's the opportunity there. The downstream companies see that opportunity and start to build the brands and product lines to tap into that. But nothing happens unless the milk comes from the farm, of course. And organic presents some particular challenges with actually building that pool of milk production. How is the Australian industry going with building a more organic supply chain, and particularly farm-based, to service what appears to be good demand growth for that product line here and offshore?
Yeah, look, there's a big recruitment drive underway, and potentially if we see the pipeline of recruitment to organic take place, we're going to see almost tripling of the size of the industry. So that's there's always a risk that if you get that sort of growth in an industry that you don't, you maybe have too much milk for the market that you're selling into, because it's still a very niche product. But there is a big recruitment drive. There is a market that's growing in terms of Chinese and offshore demand for organic infant formula. So that's the opportunity. But there's the added layer of risk around relying on one market, and one market that is opaque and with regulatory headwinds as well. So I can understand structurally the motivation and the direction we're taking, but there is always those risks when you're transitioning at such a rapid pace. So that's one thing I would say, Tim. But I mean, the challenge more broadly is, if we don't get a strong recovery in milk production over a number of years, in 3 years' time, we're likely to see ongoing pressure, and we're likely to see further supply chain resets in terms of assets being need to rationalise and so forth. So that's the risk, I guess, long term.
And Australia does seem to have been able to carve out a position of one of the centres of organic infant formula production for the world market. Why is that the case? Why have we managed to carve out what seems to be a pretty valuable niche there? Look,
I think it comes back to the value proposition that our supply chain offers. We have a perception in the market that it's a high quality product. It is grass fed, so you can feed into those sorts of repositioned milk pools and protein products. We've got access to the market, and I think the big one is the fact that we do have a lot of Chinese students and tourists that come out to the market, so they see our country, they see our industry, and they take that back home. So there is that preference where we are part of that story where Chinese consumers want international brands anyway for a lot of these dairy products, and we're one of the key international brands because of those fundamentals around our value proposition.
And that's one thing that always strikes me when we read the media, Mick, is the frequent updates on the rate of Chinese tourism into this country. We surpassed 1 million tourists a year recently. That also crossed a threshold where, for the first time, China became the number one source of tourists for this country. And the stunning related statistic that I read, that 1 in 3 Chinese tourists visits the Sydney fish market. And while they're not showcasing dairy products in there, Mick, it's still an environment in which Chinese tourists are coming in, seeing not just clean air, clean water, but food products that look unbelievably fresh, well showcased, that highlight to them the quality and provenance of the food that comes here.
Yeah, absolutely, absolutely. And that's why, it makes sense in terms of, trying to reposition a lot of our milk into those value-add ingredients. And one of the luxuries of having less milk supply and a declining production is you get to, tweak your milk pool to those value-add opportunities. Yeah.
Yep. And Mick, just a closing comment, can't let you leave without asking about how the trade wars are or aren't impacting Australian dairy. We've talked about the importance of China as a big market for dairy. We just talked about the importance of them valuing our provenance story. They're a market for high value infant formula. Is it closed up from the trade war, or it's still open channel for us?
It's still an open channel, but with some risks there, Tim. But from a dairy perspective, it is a clear focus on the impact it's going to have long term on the US dairy industry, because they're a bigger player in the global market than they were 10 years ago. They've got ambitions to become even a bigger player in the global market. So they're on a real big export drive. They've had issues beyond just the trade war with China. They've had been at loggerheads with their two other major trading partners, Canada and Mexico. So there's a lot of focus on the commercial implications of a prolonged trade war between the US and their key trading partners, with a particular focus on China at the moment, because they do export a lot of whey. It goes into animal feed in that sector, but they've done a lot of work trying to access that cheese market, which is something that we've been investing in here locally in terms of tapping into that food service channel for pizza, cheese and mozzarella and so forth.
Okay, well, long may that channel remain open, Mick. It's an important one. Thank you for your time this morning.
Thanks for having me.
We look forward to seeing you out when we head into the main stage shortly.
Thank you. Thanks, Tim. Thanks, everyone.